non-current method, the underlying principle is that assets and liabilities should be translated based on their maturity. So current assets are translated at the spot rate, and non-current assets are translated at the historical rate, in effect when the item is first recorded on the books. And this method of foreign currency translation was generally accepted in the United States from the 1930s until 1975, at which time FASB 8 became effective. So just a little bit more on current and non-current methods. Current assets translated at spot rate, like I said before, and then non-current are translated at the historical rate. So there's an example of that on the balance sheet right there, the local currency and then the current and non-current rates. So for monetary and non-monetary methods, the underlying principle is that monetary accounts have a similarity because their value represents a sum of money whose value changes as the exchange rate changes. All monetary balance sheets, accounts, cash, marketable securities, accounts receivable, etc. of a foreign subsidiary are translated at the current exchange rate. And all other non-monetary balance sheet accounts, so the owner's equity, land, etc., are translated at the historical exchange rate in effect when the account was first reported. So here's an example of that here. So all monetary balance sheet accounts are translated at the current exchange rate, and all other balance sheet accounts are translated at the historical rate. So, for example, 3 euros is equal to $1, and you can see that on the balance sheet right there. So for the temporal method, the underlying principle is that assets and liabilities should be translated based on how they are carried on the firm's books. Balance sheet accounts are translated at the current spot exchange rate if they are carried on the books at their current value. Items that are carried on the books at a historical cost are translated at the historical exchange rate in effect at the time that the firm placed the item on the books. So here's an example here. Items carried on the books at their current value are translated at the spot exchange rate. So the example there is 2 euros is equal to $1. And then items are carried on the books at historical costs are translated at the historical exchange rate. So example, 3 euros is equal to $1 there. And once again, there's a balance sheet for an example here. So for the current rate method, all balance sheet items except for stockholders' equity are translated at the current exchange rate. This is a very simple method in application. A plug equity account named cumulative translation adjustment is used to balance the balance sheet. So here's an example of that in the balance sheet here. All balance sheet items except for stockholders' equity again are translated at the current exchange rate. And the slide basically just says the same thing, and then there's an example. And the next couple of slides are just balance sheets and examples of the different methods that we've talked about. So here, this just points out the spot exchange rate and how it's the same across the board. This next one talks about the book value of inventory at spot exchange rate and the current value of inventory at spot exchange rate. So you can see that for inventory, the values do differ here as a result of the exchange rates. 3 euros is equal to $1 to 2 euros is equal to $1 in inventory. Same thing for this next slide. We're using the historic rate and the spot exchange rate. So you can see for the first three, they use the historic rate, and then for the last one, they use the spot exchange rate. And lastly, it looks like a cash plus inventory plus net fixed assets, and we see that that changes across the board due to the same exchange rate change.
Alright, so basically more examples of using the spot rate for all of these. The exchange rate from $3 to $1 to $2 to $1 in current liabilities. And same thing with long-term debt. Use this historic rate for the current, non-current, and then the spot rate for the other ones. And then, so this one requires the income statement, which we're about to see in a couple slides. And you can see that they're all different. And then the plug equity account name, cumulative translation adjustment balances the balance sheet. And then same thing, use the average exchange rate over the period, which was $2.50 or €2.50, and yeah, cents to $1. So you're using 4,000 for all of them. And same thing here, we use $333 $3 for when you translate it at €3, and then at the average exchange rate for the current rate. And then here, and there's the current non-current method. So first you solve for retained earnings, so total assets equal total liabilities, and then total assets minus current liabilities minus long-term debt minus common stock equals the addition of the trade earnings, and you add back the dividends to get net income. And to solve for the forex gain or loss, you like the difference in the profit after tax and net income, which is $300. And then, so here you're using monetary / non-monetary method for solve for retained earnings. So total assets equal total liabilities, same process. Total assets minus current liabilities minus long-term debt minus common stock equals under $50. And then you add that to the retained earnings, and then you subtract the profits after tax and income, so you get negative 550. And FASB 8 statement 8. So the statement 8 is for when you use the current date, or use the rate from the date that the exchange happened. So it's a temporal method, and FASB statement 52 is the mechanics required function currency and reporting currency, and you use this in a highly inflationary economy. So it's function currency versus reporting currency. Function currency is the currency that the business is conducted in. Reporting currency is the currency that you use for the multinational corporation. So if you're an American company doing work in Europe, it's like all the examples that you're using the euro for the function, and then you're reporting it in US dollars. And the mechanics of FASB statement 8. So it's a two-stage process. First, you determine which currency the foreign entity keeps on its books, which is pretty obvious how to do that. If the local currency in which the foreign entity keeps its books is not the functional currency, remeasurement into the functional currency is required. And then second, when the foreign entity's functional currency is not the same as the parent's currency, the foreign entity's books are translated using the current rate method. And then here's like a flow chart for how to do statement 2. Yeah, so you start at foreign entity's books, and then you go to non-parent currency and functional currency, and you see whether or not it matches up with parent currency, and then you do whatever you do based on that. And then highly
So talk about the IAS. So since January 2005, most companies in the EU, well actually all, have been using the IASB, which is the Accounting Standards Board. It's similar to the American FASB, but it publishes standards in a series of pronouncements called International Financial Reporting Standards. It is also adopted and maintains the pronouncements of the predecessor, so it's called the IAS, or the International Accounting Standards. So first we're going to talk about IAS 21, which is the effects of changes in foreign exchange rates in the European standard for handling foreign currency translation. So it most closely resembles the monetary translation method discussed earlier. In 2009, the IASB and the FASB issued a memorandum of understanding to achieve substantial convergence of accounting standards by 2011, so they kind of merged to create like one standard, and consequently most countries may soon follow a common standard for foreign currency translation. And then we're going to talk about translation exposure versus transaction exposure. So hedging translation exposure. So balance sheet hedge it's when they document and translate foreign assets into USD to protect against currency fluctuations. And then they also have derivatives hedge, so they use the derivatives to do the same type of thing. So translation exposure is the effect that unanticipated changes in exchange rates has on the firm's consolidated financial statements. And then transaction exposure is different. It's the effect that unanticipated changes in exchange rates has on the firm's cash flows. And it is generally not possible to eliminate both, but you can usually eliminate one. If the managers of the firm wish to manage their accounting numbers as well as their business, they have two methods, which is the balance sheet hedge, which I already talked about, and the derivatives hedge. The balance sheet hedge eliminates the mismatch between net assets and net liabilities, so that's when they convert to USD. So it's all the same currency, and it may create transaction exposure. An example would be the use of a forward contract with the reporting period to attempt to manage the accounting numbers. So same type of deal. So when they're converting to USD, so it's a common currency to avoid fluctuations. And using a derivatives hedge to control translation exposure really involves speculation, so they have to kind of guess. The effect that unanticipated changes in exchange rates have on the firm's ongoing operations. And the difference is the operating exposure is a substantive issue which the management of the firm should concern itself with. And then we're going to talk about FASB 8 and then it changed to FASB 52. So there would not appear to be a reevaluation of the firm's values following the change after the change to FASB 52. And it suggests that the market participants did not react to cosmetic earnings changes. And then other researchers have found similar results when investigating other accounting changes. And this is just a summary of everything we talked about. So, translation exposure relates to the effect that an unanticipated change in exchange rates will have on the consolidated financial report. So that's why they consolidate and change all their currency to USD to avoid fluctuations. And the 4 recognized methods for consolidating the financial reports of an MMC include the current and non-current method, which we've already talked about earlier in the slides, and the monetary and non-monetary method. Also, he talks about the temporal method and the current rate method. The old translation method, which was FASB 8, and they switched it to FASB 52 because of what I already talked about. And when they implemented FASB 52, the functional currency of the foreign entity must be translated into reporting currency. So again, they changed it to USD so to avoid fluctuations and keep it all the same. If it is not, the temporal method of translation is used to remeasure the foreign entity's books into the foreign functional currency. And then the EU follows the International Accounting Standards 21, which is a monetary and non-monetary translation method by the International Accounting Standards Board, so the IASB. And then a case application illustrating the translation process of the balance sheet of a parent firm with 2 foreign wholly owned affiliates, according to FASB, was presented after they changed from FASB 8 to FASB 52. And there are 2 ways to control translation risk, which we were presented, which was the balance sheet hedge and the derivatives hedge. So it's obviously to protect against fluctuations.
One of your students came to me today.
Maya?
Yeah.
Yeah, I told her, I was like, because I mentor her, and I was like, I go to Marielle, like, she's your mentor, like, she'll definitely help you with all of it.
Yeah, it does. We went through her 4 years ago. She
Okay,
was like,
great.
Mama, was it this? Who's the 11th?
I was like, she's super nice, just go, she'll help
So,
you. She's
see,
fine.
look, they listened to us. Let's hear back.
These guys are probably the invisible men.
Okay.
Yeah. Something to lecture.
Are you guys presenting? Yeah.
You're going to need to make a little bit of I'm not the same place as well, sorry.
But yeah, it's the best thing ever. Like, no one's done it. Where's PwC filter? Yeah. Are you still more than three?
He's known that.
Okay, so we did chapter 12, international bond market. The world's bond market is
All right, everyone, listen.
the total market value of the world's bond markets are about 50% larger than the world's equity markets. The US dollar, the euro, the pound sterling, and the yen are the four currencies in which the majority of domestic and international bonds are denominated. And these are some examples of foreign bonds and euro bonds. And this is an example of international bonds amounts outstanding classified by major instruments in billions of USD. Bearer bonds and registered bonds. Bearer bonds are bonds with no registered owner. As such, they offer anonymity, but they also offer the same risk of loss as currency. Registered bonds are bonds where the owner's name is registered with the issuer. National security registrations many borrowers find this level of regulation burdensome and prefer to raise US dollars in the euro bond market. Withholding taxes. Prior to 1984, the U.S. required a 30% withholding tax on interest paid to non-residents who held U.S. government or U.S. corporate bonds. The repeal of this tax led to a substantial shift the related yields on U.S. government and U.S. dollar bonds. Security regulations that use bonds issuance. Shelf registration allows the issuer to pre-register a securities issue, and then they offer the securities when the financing is actually needed. Sec Rule 1448 allows qualified institutional investors to trade private placements.
Can you speak up a little bit?
Yes.
I don't think these guys can hear you.
Okay. A global bond is a very large international bond operated by a single borrower that is simultaneously sold in North America, Europe, and Asia. Global bonds, denominated in U.S. dollars and issued by U.S. corporations, trade as euro bonds overseas and domestic bonds in the U.S. The Deutsche Telekom Global Bond, the largest corporate global bond issued to date, is the 14.6 billion Deutsche Telekom multi-currency offering. The issue includes 3 U.S. dollar tranches with a 5, 10, 30-year maturities totaling $9.5 billion. And these are types of instruments.
All right, so this is the typical characteristics of international bond market instruments. Like listed in the last slide, we have the straight fixed rate, the floating rate note, the convertible bond, straight fixed rate with equity warrants, and dual currency bonds. As you can see, the size and coupon type, they're all variable. They're all fixed except the floating rate is variable. These are plain vanilla bonds with a specified coupon rate and maturity and no options attached. Since most euro bonds are bearer bonds, coupon rates tend to be the annual rather than semi-annual. Floating rate notes, just like an adjustable rate mortgage, common reference rate, a 3-month and 6-month US dollar. Since floating rate notes reset every 6 or 12 months, the premium or discount is usually quite small, as long as there's no change in default risk. The equity-related bonds, there are 2 types of equity-related bonds, such as the convertible bonds and bonds with equity warrants. The convertible bonds allow the investors to exchange the bond for a predetermined number of equity shares of the issuers, such as the floor value of a convertible bond is straight fixed rate bond value, and convertibles usually sell at a premium above the larger of their straight debt value and their conversion value. The zero coupon bonds is PV equals par, over 1 plus r to the t power. And these are usually sold at a large discount from face value because there's no cash flow until maturity. Composite currency bonds, they denominate in a currency basket like the SDRs and the ECUs instead of a single currency. They're often called currency cocktail bonds, typically straight fixed rate debt. Again, these are characteristics of international bond market instruments. Like I said before, the majority of them are fixed except the floating rate note is variable, and the zero coupon bond, the size of coupon is 0. This is a graph of the currency distribution of the international bonds amount outstanding. You can international bond market credit ratings, Fitch, IBC, Moody's, and Standard & Poor's self-credit ratings analysis focus on default risk, not exchange rate risk, assessing sovereign debt focuses on political risk and economic risk. The international bond market indices, there are several international bond market indices, JP Morgan and Company, such as domestic bond indices, international government bond index for each country, widely referenced and often used as a benchmark, and appears daily in the Wall Street Journal. Thank you.
I was
Okay, you guys are all see your thing up here. Right there. You guys all see this? You guys hit the skull email? Cool. Don't forget to order those. Yeah. People come back and they're like, I ordered that. Like, where's your thing? Like, they have one that they fry. They run out. No, they don't. As long as you order it. Do it right now, but people...
literally all of them are on.
Just do it. Yeah.
Did they send you the crazy one?
Will freak out.
Oh no, it's a metaphor.
Yeah. So wait, no. But that was so successful. There were so many people there. More people than there were like because we had whistle in there and two students and Mary Allison.
So weird.
So I just think if you're going to be a leader and you're saying that you're a leader on your resume and you're not following through, that's dishonest. I think I'd rather have a smaller board that shows up and
That's all I care about. Okay, cool. What was your alpha on
hold
that?
all of the people on board and everyone's attention and says no. And she has that. So she's bringing that forward. Oh, your manager, yeah.
So pull out your blue book and write your name on it, write the date, and then write the title here. And you're gonna take notes and you're gonna put this in. Yeah, you're gonna put this into your deliverable too.
Appreciate it.
I thought I would entertain you for the last half hour. How many people are going on to grad school? Not right now, but in the future. Okay, awesome. Excellent. So you'll be asked when you get into these programs to do exactly what you did on that article worksheet that I had you do. So you can read an article, or you read a bunch of articles, and you put together a presentation. And this is an example of what I did in my doctorate program. It's directly related to this class, okay? So what we're gonna talk about is the nature of management of foreign exchange risk. And we're also gonna talk about product innovations, because most of the products that have been innovated are on a global basis now. And there's huge opportunities. I just got off the phone this morning with a colleague of mine out of New York, and I'm putting together a panel on indexation and product innovation in the real estate capital market space. And a lot of the same methodologies in index construction and product development are exactly the same. We're just focusing on the real estate applications. This just happens to be foreign currency, is what we're using as the underlying asset. Okay. So what I'm going to go over quickly today is I'll do a little introduction, recent foreign exchange experience, market volatility and correlation, spot and futures rates, the deviation from purchasing price parity, correlations with market fundamentals and across rates, forward rate bias, the efficient market hypothesis forecasting, spot rates, interest rate differentials, forward rates, and then forecasting and trading models. So this is a pretty good, I think, fundamental and technical presentation. In contrast to earlier periods, financial and foreign exchange markets in the 70s, 80s, and 90s and 2000s have become more risky. If you just look at the peso crisis in 95, the Thai baht collapse in 97, Russian default 98, Y2K 2000, dot-com bust 2001, housing bubble 2006 and 7, housing bust, financial crisis 8, 9, 10, and now we're probably in what you're seeing is a popping of the bond bubble currently, and we'll see what happens to the stock market soon enough. The emerging markets most of them are in recessions right now. We've seen an inverted curve recently, which is dislocating the markets. So you as managers are just operating more in a more volatile environment than at any other time in history. And you're gonna really have to understand not only how to manage through that volatility, but what are the tools that you're gonna be using to be able to hedge off that market volatility and that risk. If you're lucky, you got financially engineered products as tools to be able to hedge off that risk. If you don't have the tools and the derivatives available to you, you're gonna have to come up with your own risk management techniques and processes, and maybe do what I've done, is actually develop new products to be able to solve the problem. So you have to start thinking, how are you gonna solve these problems? And that's all you're gonna be doing on your job. Is they're gonna come to you and say, we got a problem. How are you gonna solve it? And then figure it out, okay? And there might be tools and techniques and processes and standards that have been developed for you to be able to answer or solve that problem, but you're gonna have to be creative in how to solve these problems, because you may not have the resources available to you. And you have to garner resources internally and borrow resources and beg for resources in some cases. And if you don't have the money to motivate people to work with you, you're gonna have to use your charisma and your communication capabilities to be able to induce them and motivate them to work with you to solve the problem. That's gonna be a huge issue for you, but if you get good at it, things will be a lot easier. So we've seen large fluctuations in interest rates, expected inflation, expected real risk-adjusted rates of return, and political and institutional structures determines institutional capital flows and volatility. And I would say the political, policy, and institutional realignment that's going on right now is having a major effect on the capital markets right now and on currency and capital flows. We're seeing a realignment institutionally with populism out of Europe and definitely populism here. So we're seeing a realignment and an attack on basically democratic institutions, capitalistic institutions that have been in place since basically World War II. Again, that just adds more volatility and makes it harder for you to manage in the environment. International monetary and fiscal policy coordination and intervention has helped to stabilize capital flows and currency fluctuations. Although if you look at central bank coordination, they all basically printed trillions of dollars to bail out the banking system that had collapsed. And we're still basically dealing with the legacy overhangs of those bond portfolios that are currently on the central bank balance sheets. The question will be is, what does the next financial crisis look like? And can we print another, $30 trillion to bail out the system again? Probably not. Can we lower interest rates and run budget deficits and rack up huge sovereign debt loads? Again, probably not. So we've kind of running out of bullets for both fiscal and monetary policy, which just makes it harder on us to basically be managers going forward. But I think you can handle it. You just need to be aware of it. The underlying economic and political and institutional fundamentals determine long-run trends in foreign exchange rates. Economic analysis and the need for hedging instruments has led to innovations in foreign currency and security markets. And here are the product innovations, and this is just a sampling. There's more products that have been developed since I wrote the paper years ago. But still, it just shows you how innovative finance is, and how the introduction of these products are really tools, techniques, and technologies to basically solve real-world problems in the marketplace. So floating rate notes was a major innovation to be able to manage changes in interest rates for both your liabilities and your assets where they move together. Instead of having fixed on each side, they floated together, so you're matching basically the costs of your capital and the returns on your assets were floating together. So it was an immunization scheme. Interest rate and foreign exchange swaps, swaptions, options on the swap contracts, interest rate caps with floors and ceilings. You have option contracts, foreign exchange rate options, foreign exchange rate forwards, interest rate options, interest rate futures, and zero coupon bonds and other types of securities. So again, and the list just goes on and on and on. Okay. And for a lot of you, you'll be working particularly at PwC, is that correct? Yeah. PwC and at the other accounting firms. Excuse me?
Say the accounting firm. Are you saying that my accounting firm is less than?
No, well, just as long as you're in the big four, you're okay. No, but you might be moved over into the consulting side of the business where you might be doing some derivative audits and some managing and looking at the derivative books for a lot of these multinational corporations. So you might be involved in that side too. So you're going to need to understand these contracts. So financial innovation and derivative markets were developed in the 70s to lower interest rate and foreign exchange rate risk. And then later on, the credit swaps, credit default swaps, the CDOs, and others were invented to be able to swap off and manage the credit default risk premiums and credit default between counterparties in particular. The collapse of Bretton Woods in the early 1970s moved foreign exchange markets from a fixed exchange to a managed floating exchange rate regime. And actually at the same time, in the early 1980s, what they did was they basically lifted interest rate, the Federal Reserve basically walked away from fixing interest rates and letting interest rates float and really targeting the money supply. So basically at the same time, you had floating exchange rates that were introduced in the 70s, and by the 80s you had floating interest rates. So within 20 years, you had major market risk that a lot of these institutions and corporations had to hedge off. So the results were wide fluctuations and increased uncertainty in the marketplace. Wall Street came in, and a lot of these innovations came out of London too. They innovated and invented exchange-traded foreign exchange futures contracts on the Chicago Mercantile Exchange, exchange-traded foreign exchange option contracts on the Chicago Board of Trade, and then the foreign exchange rate forward contracts, which is over the counter, private market, and the foreign exchange rate swaps, which is also a over the counter private market. Okay. The swaptions are actually on the exchanges. So you have usually what happens is the innovations in these products will develop in the over the counter market. Once the over the counter market reaches some scale, then the contracts will be replicated and standardized and basically made available on the CBOT and the CME on the exchanges. The information revolution of the 70s and 80s, and I would even say the 90s and 2000s with cloud computing. I mean, when they first came out with the mainframe, in the 50s and 60s, and then with the personal computer in the 1980s, really revolutionized finance, because now we could basically do the calculations in factorial form. We could handle major calculations, and then not only be able to data process it, but but now we can data process it, we can store it in a cloud environment, and basically we have infinite capabilities of processing and infinite capabilities of storage at this time, which will revolutionize finance. Again, it is revolutionizing it right now as we speak. Gave institutional investors and speculators the computing power necessary to process massive amounts of pricing data. This allowed them to compare security foreign exchange prices between spot and derivative markets, identifying mispricing and arbitrage opportunities. So now if there's any arbitrage between any of the markets, it will be identified instantaneously in an arbitrage way. So the markets are constantly looking for mispricing and arbitrage. And now with machine learning and artificial intelligence, the ability to take advantage of those mispricing and arbitrage opportunities will be significantly enhanced. The results were cross-currency arbitrage and portfolio insurance, which is what we went through, on the exam, both in the pre-test and on the exam. So what we're seeing and what we saw was capital market reforms, privatization, emerging markets in particular, privatizing their public assets, securitizing them, and then creating stock markets, and then those companies issuing bonds, creating bond markets in those countries, allowing for the channeling of external capital to come into the countries to basically capitalize the capital investments in large infrastructure projects and other private goods and services. The collapse of the Soviet Union and the whole democratization and the acceptance of democratic capitalism as the form of governments and the economy, and rapid economic growth in newly industrialized countries and emerging capital and foreign exchange markets. And this continues to go on today. However, I'd say the majority of the adoption of this has already been done. So we're kind of in a late stage, maybe even at a late majority stage of adoption of these types of institutions and markets and tools. What is foreign exchange risk? It's the chance that fluctuations in the exchange rate will change profitability of transactions from expected values. Real foreign exchange risk is the fluctuations in exchange rates that are not matched by offsetting changes in price levels at home and abroad. These are the deviations from the purchasing price parity, or what is called a misalignment. It also affects international competitive positions and the underlying profitability of its businesses. The next is information costs. Financial innovation has contributed to the collapse in surge costs associated with asymmetric information and efforts to mitigate moral hazard and adverse selection in the lending across borders. If you want to read more about these information costs and asymmetric informations and moral hazards, I would read, and you may want to write this down, I would read Ronald Coase, C-O-A-S. He was basically the father of this theory, and Kenneth Era was also a major contributor to the literature in this area. They basically set the foundation, really is the underlying foundation for behavioral finance and behavioral economics. Purchase and sale of foreign currency and interest rate futures and options from exchanges and settlement through clearing institutions reduces search and transaction costs associated with hedging. The results will reduce credit default risk, premiums, lower financing costs and increased market liquidity, improved information dissemination, ability to better price credit risk, and ability to better diversify credit risk. Future innovations will be, and this has already occurred, credit-based foreign derivative products. And then I'm hoping that there will be innovations within the real estate securities space, both derivatives and options and futures contracts. And I got off the phone today with one of my colleagues, and it sounds like there has been some innovation in that space, but there's been some setbacks within the last 2 years under Brexit. So the Brexit is basically realigning the ability to innovate new product and trade actually existing derivative contracts out of London, because the Brexit deal is basically changing the institutional arrangements of the derivative capital markets currently. So it'll be interesting to see what happens, but I think it'll be extremely disruptive. It will just increase the costs of the derivative transactions and the ability to trade once we decide what happens with the Brexit. So Brexit will be a major systematic risk factor. It will be a systemic risk to the global capital markets going forward until it's finally resolved. And even if it's agreed upon, it takes years or decades to realign the institutions and the capital markets to the new regimes. So it'll be extremely interesting to see, but it'll be problematic. Foreign exchange rate volatility. This is the changes in intrinsic values of foreign exchange are caused by unstable and random fundamental economic information flows. So obviously as the information flows to the markets are efficient, so they're going to react instantaneously to those information flows. Information flows on monetary and fiscal policies, economic growth, balance of payments, public debt, interest rate differentials, inflation expectations, credit risk premiums, expected risk-adjusted rates of return, capital and currency controls, and coordination, intervention, integration, and deregulation in these capital markets. So looking at deviations from purchasing price parity in the long run, so over 5 years, looking at forward floating rate instruments. These deviations or changes in intrinsic values of foreign exchange are caused by persistent deviations from purchasing price parity or changes in real exchange rates. So you have to take into consideration the inflation differentials between the two countries. This is the nominal exchange rate times the foreign price level divided by the home price level. So you have to take into consideration the inflation and inflation expectations. And you have to note that the purchasing price parity, the changes in the differentials exactly offset the changes in the spot rate. So any changes in the inflation rate or interest rate differentials will be instantaneously reflected in the exchange rate movements. So it basically means that exchange rate movements in the marketplace are caused by changes in the differentials between interest rates and inflation rates. In the short run, movements in the exchange rates in nominal exchange rates. In the long run, it's going to be movements in exchange rates and inflation expectations. So the reasons for the deviations in PPP, actual or expected changes in central bank reactions in monetary and fiscal policies, productivity differentials, and capital controls. The next is to look at foreign exchange rate correlations. You can look at monthly changes. When they looked at monthly changes, they were uncorrelated. But if you looked at weekly changes, they were also uncorrelated. But daily correlations were correlated with each other. So there's no correlation in monthly or weekly changes, but there was correlations in daily changes. The correlations between spot and forward exchange rates, they were highly correlated. This is called the peso problem. The foreign discount was less than the devaluation. Foreign rates consistent, either positive or negative bias predictors of future spot, and these changes were due to macro risks. You cannot be forecasted using lagged forward rates, and most changes are unexpected or random and a result of new information that flows into the markets. Exchange rate correlation with macro variables were extremely weak and unstable. When you looked at money supply, current account, there was inconsistencies in economic relationships, rapidly changing expectations, and strong correlation under hyperinflation. Cross-exchange rate correlation, you looked at the change in the spot rate, and it was the beta times the change in the spot rates. The beta was unstable over time, and positive betas, depending on the base currency, was based on the base currency and monetary system and intervention through interest rates. The efficient market hypothesis. Under the strong form, all public available information, including insiders, is taken into consideration. In the weak form, all publicly available information, such as your graphs and the history of the price trends, are already taken into consideration in the spot prices. Exchange rate reflect all information in the market. Current rates are best predictors of the random walk, and investors are unable to monopolize on the profits. The assumptions here is there's high market liquidity, informed traders, price expectations are sensitive to new information, and and this causes the volatility. Random walk models, you can use a drift model. When you use the drift model, you have to log the exchange rate, which equals the expected growth rate, plus the log of the prior period spot rate, plus any unexpected inflation rate differentials. You can also use technical analysis to forecast exchange rates. Short-term intraday. This is based on price history. You've already done that when you were doing the currency technical analysis and you were doing the stock market technical analysis. So you actually have to print those out and do the technical analysis and identify the supports, resistance, the trends, the consolidation, the trading ranges, the accumulation phases, and there's other techniques that you would use on the technical side. You're looking at momentum, moving averages, resistance, support, breakouts, trading regions, consolidation, channels, flags, head and shoulders, stochastics, and other sentiments and other types. We've already gone through a lot of that stuff. Serial autocorrelation of the prices is assumed in the error terms, so there's adaptive intervention expectations. So there is, when you see momentum, breakouts of momentum and trends in your pricing for these currencies, spot prices and futures prices, that's called serial correlation. There's autocorrelation. So historical prices and momentum carry over into the future. Fundamental analysis is long-term econometric. There's lack of theory in this area, real-world variables and expectations measure. You've already built the model. You looked at the 5 factors that drive currency rates up and down. You looked at the structure of the regression equation. You looked at you're going to do the foreign direct investment regression analysis that I developed. It looks at the factors that drive foreign direct investment, and a lot of those actually drive currency rate depreciations too. Fundamental forecasts are embedded in the price. The price and the appreciation is the dependent variable. Data, unfortunately, is inadequate, untimely, not relevant regarding institutional arrangements. So you can do all the fundamental analysis that you want, but at the end of the day, when you're looking at currencies and you're trying to forecast where the currency values are going, either in the futures market or in the spot market, you have to look at the governmental and the capitalistic institutional arrangements to really be able to forecast correctly. In most cases, the variables that you've identified, the variables I identified, do not include institutional metrics, do not include institutional variables within your forecast model. Maybe I'll leave that up to you guys to develop some of those metrics so that we can do a better job of forecasting these currency values going forward. I don't think there's enough that's done in political economic analysis to create variables to include in your forecast models to do a better job of forecasting. So risk management strategies. Increase volatility in interest rates, exchange rates, and forecast errors. Let institutions to find ways to insulate their portfolios. Interest rate and foreign exchange rate changes cannot be accurately and reliably projected, although I disagree with that. But it is possible to hedge against the effects. Hedging lowers interest rate and foreign exchange risk, but also reduces potential profits earned by correctly anticipating the direction and magnitude of interest rate and foreign exchange rate changes. So the methodology of risk management strategies. First, you need to assess management's views of risk. You need to reduce the variability of firms' net foreign exchange cash flows, profits, earnings, and returns. You need to implement diversification strategies to eliminate unsystematic risk, and then hedge off the systematic currency risk using the either risk management strategies or the derivative contracts. You need to assess the costs and the benefits from hedging strategies and the impact on shareholder value if you're a multinational corporation. So what are the strategies? There's passive and active strategies. When management lacks the ability to forecast exchange rates, good insulation from unexpected changes in foreign exchange rates, low transaction costs, and 1-year forwards, futures, and options and swap contracts would be used. An active approach is when management wants to participate in the rate movement. So forecasting rate movements, and they're trying to profit from the rate movements, either through arbitrage trading or by taking positions within the derivative contracts. So how do you hedge off? What's the theory behind hedging? It's asset liability management. This is a medium-term translation risk strategy. The risk management strategy used by banks and other financial intermediaries to immunize their portfolios is to set the duration of a foreign loan or security portfolio with the length of the investor's planned holding period or the contract period. So you're matching the duration with the contract period. So it's asset liability management. And if you can do that, you can immunize the risk. When interest rates rise, falling duration will reduce the currency value of the portfolio, but interest return on the reinvested foreign cash flows will increase by the corresponding amount. The total return from the portfolio will be stabilized. The same is true if rates fall. The next is immunizing strategies for multinationals and money center banks. Again, asset duration equals liability duration. The limits of the strategy is the ability to match the holding periods. Interest sensitivity analysis, or gap management, is setting interest-sensitive asset receivable holdings equal to interest-sensitive liabilities or floating rate notes or the CDs of the institutions. That was a major innovation at the institutional level. For example, an international money center bank holding floating rate notes tied to foreign market interest rates could match them with foreign floating rate loans. As bank interest costs rise, so will its revenues. A hedging strategy using foreign currency and interest rate forwards, futures, option contracts protects the net interest margin or the gap between revenues and expenses. How are we doing on time?
10 minutes.
Okay, cool. I should be able to finish it by now. So what are the instruments that we use? Forward contracts. These are custom future contracts with specified price, maturity and size, and cash flow uncertainty. Again, these are custom. These are over the counter. Futures contracts are ready-made with a specified price. They have few maturity dates, quarterly, organized exchanges, fixed contract sizes, no credit lines required, easy access, low margin requirements, high liquidity, cash flow uncertainty, and management intensive. And again, if you enter into any of these contracts, let's say you want to hedge off rising oil prices in the future, you're going to go long, the forwards and the futures. But if all of a sudden the oil prices start to fall, you can offset the position by writing the other side of the contract and close out the position. Does everybody understand that? So you buy the forward, starts going down. To offset the position, you write the futures contract and you get out. Go long forwards, go long futures, and then you write the forwards and the futures when the position starts going against you and close out the position. There'll be some transaction costs, but you won't be exposed to the position, you won't be held naked in the position. Option contracts are specified price, limited maturities, do not have to be exercised. They're hedge contingent exposures, small amounts, liquid, low margin requirements, cash flow uncertain. You have to pay the premiums and they're management intensive. And the swap contracts, these are over the counter too, except for the swaptions. Have specified dates, prices, series of forwards. They're thinly traded, management intensive. You have to have extensive documentation, and actually the spreads are wider and the transaction fees are more expensive too, because you're entering in with the investment banks. Other risk management strategies and techniques. These are more the strategies as opposed to the tools. So you need to understand the difference between the two. There are risk management strategies and then there's risk management tools. The derivatives are the tools. The management strategies, the risk management strategies are actual strategies adopted by the management team. So borrowing and lending. You can create synthetic forward positions where you're borrowing in the home market and lending abroad. You can do long-short forward positions. You could use these when forward and swap markets are thin. These are management intensive and there's high legal restrictions. Commodity hedging, you're going to go long-short, foreign proxy commodity contracts to hedge foreign asset or liabilities. These are deep commodity markets. They have short maturities, and they cannot exactly offset your risks. Leading and lagging, the speed up or slowing down of receivables and payables, avoiding hedging costs. You're not able to match maturities, and they're management intensive. And then you're matching assets and liabilities and common currencies. You're avoiding hedging costs. They're difficult to match maturities, and you have to deal with currency flows. So in conclusion, the future innovation in foreign exchange markets, the acceleration and flow of foreign financial innovation will be determined by the degree of technological and telecommunications innovation, the degree of financial and industrial deregulation and re-regulation, particularly through the tax code. Demographic changes such as migration, baby boomers, Gen X, Gen Y. I mean, we read today about the millions and millions of people coming over the border from Syria into Turkey and into Western and Eastern Europe, which will have a major impact. And now basically we're seeing massive migration flows coming up from Venezuela and Central America into Mexico and into the United States. So there will be major impacts by that. Internationalization and privatization, so continuation of emerging market development. I think we'll see Africa probably, I hope, at some point enter the emerging market and really industrialized realm, but the geopolitics there is extremely challenging. Environmental degradation and resource allocation, obviously, that's becoming a major issue, and we'll probably start to see product innovations in the sustainable space and in energy or renewable energy. Infrastructure funds and derivatives and indexes will start to come out of that space right now, which I'm working on with a client right now. Political stability or instability, you can see what Brexit is having currently, not only in Europe, but will have a major impact on global capital markets and international trade. Also, in conclusion, you have to have a systems approach to understanding foreign exchange risks. You got to understand the philosophical systems in which these cultures basically exist in, both their ethics and moral systems. You have to understand the legal institutions in which their societies are framed and how laws are actually governed and administered and actually decided on. Either it's based on the rule of law or contract enforcement, maybe it's Western, European, civil law, or maybe it's Sharia law or some other type of law that was adopted from the theological systems that predated the modern legal systems. You have to look at their political systems. Are they democratic? Are they authoritarian? Are they parliamentary? That will have a major impact on these currency markets and currency directions. You have to look at the economic system as an authoritarian system, command and control, one-party system like China, or is it liberal capitalism like it is out of the UK and France to a certain degree in the United States? Is it corporatist, which is more German, the German model? Or is it more socialistic, which is your social democratic states of Finland and Norway and Denmark are good examples of those regimes. Again, that will also have an impact on the currency values. And then the financial systems, the efficiency of the capital markets, the liquidity, the availability of securities within the marketplace. So the degree of financial innovation in foreign markets is dependent on the accepted medium of exchange for low-cost investment transactions. A strong macroeconomic infrastructure consisting of developed legal systems and enforcement of contract, corporate, and securities law, standardized accounting and disclosure requirements such as GAAP and international GAAP, equitable and efficient regulatory tax system, preferably a progressive tax system, and government oversight of public and private financial institutions to mitigate adverse selection and moral hazard in the system. Testing and measuring foreign exchange risk, you have to look at macroeconomic stability, capital market liquidity and efficiency, public and private market discipline, information and capital costs and controls, corporate government transparency and communications, portfolio diversification strategies and risk management tools, exit strategy, convertibility and liquidity to be able to get out of your positions, capital formation, efficient allocation of resources, wealth creation and distribution, and in the end, increased social welfare. It should be the ultimate goal for these institutions. That's all I got. I'll send this to you and I'll post the lecture on LinkedIn. You don't want me to look at anything? I think, Eric, I still have your deliverable, and Jonathan, I have yours too if you want to go over it. Okay. Hello. I think he should turn it in himself. Oh, is he? Okay. Then put it there. I usually like to have the principal hand me the deliverable themselves. Oh, is it? Okay. Thank you. I still like people to hand them to me by the.
Yeah, but he's gone.
I know. He could have handed it to me on, let's see.
I think he got it back on Wednesday.
He could have given it to me on Monday.
He's an overachiever, I guess.
I think he wants a job.
He has a job.
I think he's looking for another one.
He has one.
Oh, does he? Oh, okay. And how about you? How about, do you want to do the TRI, investing sales runner, $50,000 start? Huh?
Oh, TRI.
TRI commercial and recruiting.
I emailed them.
Did you? Did you
Yeah.
call them?
No, I emailed her like a long time
Did you
ago.
call them?
No, because she responded to me.
She did, but she's like,
She was like, I was out of the country.
okay. So give her a call and set up a time if you're interested.
Is it not already taken?
I haven't heard anything. I can't find anybody to take it. Everybody says, oh yeah, I'm totally into it, but I never have to.
I applied to like a bunch of CBRE ones.
What, through the website? How'd you apply through somebody else? You want to write down this person's name. I'm going to give you a person's name.
TRI one?
CBRE. Unless I already gave it to you. Did I give you Lauren Morgan? Okay.